Hey everybody, this is Brant from Wolf on Wall Street with a market update for the week ending August 23rd, 2019. And they are back, CNBC, with the markets in turmoil Friday night. Wouldn't it be really cool if CNBC took all the smart people that they have on air and they actually gave people some information that would be useful before markets were in turmoil? Well, that's what I'm trying to do here today and every weekend. So here's the SP 500 weekly chart. Let's zoom in a little bit closer. And what you'll notice is 4 weeks down for the market. The NASDAQ, I showed this chart last week. Look what's going on here, a little parallelogram. That looks like a bear flag. It is a bear flag. So here's a daily chart for the SP 500. This is this week. This is Friday. So you can see closed down near the low of the day and the low of the week. That is bearish price action on Friday. Moving averages, 50-day moving average, basically did not get tested. Resistance, we got the 200 below still. Kind of the same deal for the NASDAQ 100. Here it is, 50-day average resistance this week right there. 200 days below, there's that flag. You can see it, draw trend line here, draw trend line there, bear flag. Then we have the Dow. So the Dow did come into technical or psychological support at the 200-day. You can see right there, it closed right on it. I always talk about small caps and the way they lead the market. So let's look at small caps on the week. Here they are, resistance at the 200-day. Notice they are well below 50 and 200-day moving average. Small caps tend to lead the broader market. So when you look at the S&P 500 and you say, which way is it going from here? Well, you have to take into consideration what small caps are doing. They are leading lower. And here is the S&P 500 daily chart. You can see this range of consolidation. This is typical after you get a big sell-off. You get some kind of consolidation. And these 4 candles are Monday, Tuesday, Wednesday, Thursday. There's Friday, so you can see a bad reaction on Friday. We'll get to why in a minute. First, this is the S&P 500 5-minute chart. So this is the week. As of last weekend, I showed some charts of IWM 3C charts. And I said, I think we might have a little bit more upside coming into this week. And that's what we got over here. But the rest of the week was sideways. Tight range, about 30 points. And let me back out. You can see it here. Within this big range, this is last week, Monday through Thursday. There's Friday. And there's very, very low conviction on the part of buyers. So you can see almost all the gains came from the overnight session or extended hours, like this gap up here, this gap up here. And in the cash market, just going sideways. No action until Thursday. We got the most volatile day of the week at that point. Here's the IWM 3C chart I showed last Friday. And this is why I thought we'd have a little bit more upside into this week, which you saw right here. Had a little positive divergence in small caps going into the end of the prior week. So this is that sideways range Monday through Friday, or I'm sorry, Monday through Thursday. And you can see what 3C is doing is just moving lower, lower highs, lower lows, trending lower as prices are trending sideways. That is a negative divergence. Doesn't necessarily say that there's like heavy selling, but it says that the buyers here have no conviction, and this is a market ripe and ready to fall because there is no conviction in the buyers' ability to support prices. And here on the slightly longer term 3-minute 3C chart, that means just a little bit less noise, a little bit more trend. Here's that past week, really nothing going on here, but then acting like IWM, negatively diverging into Wednesday and Thursday, and then boom, here's Friday. Let me show you from QQQ's perspective. So this is a 5-minute chart of QQQ this week, Monday through Thursday. Here's Friday. So here's that range again that you can see. Nothing going on in the cash session, just all overnight, all overnight. But then Thursday, we had the most volatile day of the week with this big sell-off in the morning. And then the rest of the day was a consolidation up to this trend line in the afternoon. And then we go into Friday morning over here. Let me zoom in a little closer. So here is QQQ on Thursday. There's the trend of consolidation to the trend line and a break on Friday morning. So I viewed this as a first leg down, a consolidation. So when we got a sell-off Friday morning, I was looking for a downside move right here, a measured move down to about this area, 185.65. Came close. Then Powell spoke and the market basically rallied back up and tried to fill this gap. Now I want to show you something really important. I talked about this a lot last week in the video. Treasury yields and the markets have their highest correlation in years right now. So Treasury yields are leading the market around by the nose. So why people are buying this dip thinking what Powell said was dovish, which it really, really was not. It was the bond market sending signals that this was trouble. I sent out a post sometime around 11 a.m. in the morning. I think I had 13 posts on Friday. Very, very busy day. Okay, so this is Thursday. This is the S&P 500 in candlesticks and the 10-year yield in white. Thursday morning, Yields led the market lower over here, led them higher over here, making higher lows, and then into the afternoon started leading lower. This is the end of Thursday for the S&P 500. Going into Friday morning, here's the gap down. Okay. There is the rally back up into the gap. You can see it over here. And just watch what this 10-year yield is doing relative to the S&P. Oh my Lord. So this is when I sent out that post and I said, yeah, the market is rallying. This is not good. This is not good news. The market did not take Powell in a bullish way, even though the market's rallying on it initially, and yields are leading lower. And boom, watch what happens next. Bow. Okay, and just led lower throughout most of the afternoon. So this has been a really, really strong edge for traders trading day to day. This was the signal that this was not a rally or a bounce that was going to hold. And to just kind of put a fine point on that, this is a 15-minute chart of the S&P 500, the 10-year yield in white. This is the end of June going into July. And this is what I was saying about July. You know, the yields were just starting to peel away from the averages, led lower big time here, actually right here as well. And then as we come into this 3-week consolidation, this is the last week, 3-week consolidation, look at the equal highs in the S&P up here around 29.38. You have 1, 2, 3, 4 of them. Okay, 1, 2, 3, 4. What is the 10-year yield doing? Lower high, lower high, lower high. It is leading the market lower, just like we saw right here on Friday. And then this is the daily chart I showed last weekend, where you have a major difference of opinion. One of these markets is very, very wrong, and it's usually bonds that are right. So let's go back to QQQ intraday and look at some bear flags. QQQ on the week, Monday. Here's Friday morning over here. Let me go back to a 1-minute chart. So here's the first one and the measured move down for Friday morning. And then let's see the sell-off. Remember, yields were leading lower. So by about 11 a.m., we got another bear flag, and I sent out a update to my members and gave them a measured move target for the rest of the day. And I'll show you how I got to that. I took this little consolidation and on a log chart, pretty much just drew in a measured move. I used to do these in points, count points, but this is a little bit easier. And then put this under the flag. So we have the same concept as on the daily charts and the 60-minute that we're going to get to. Usually you have sell-offs, they come in a first leg, a consolidation, that's a bearish flag, and then a second leg down. So this gave me a measured move target of down here around 181.50, and my target was 181.50 to 182 for the rest of the day. I took half the trade off there, and then let's walk this forward. And we come down again, look, another bear flag. And this is the thing about trading these bearish moves. You have to manage the trade. So you get a big drop like this. I took half off here. I took the rest off here, but I had a lower target. So if I had more time on my options, I absolutely would have left them open. But my point is, you have to manage these trades. So the big first sell-off always gets very emotional. You have a waterfall decline, more or less. But then you see what bear markets really tend to trade like, and that's like a slow grind lower. So what I did was just confirm my downside target, and I'll show you how. Again, it's just a measured move. So I just took where this flag broke down, just moved this under this flag where I would anticipate that breaking down, and let's move forward. And here we go. So there is the next measured move, and you can see that measured move is down here at 182. Trade right down to that measured move at the end of the day. Now, had I had more time, because my options were expiring over here, I would have absolutely left that open. So I went from almost worthless puts on Thursday to about a 5% gain for that trade. But that could have been about a 225% gain if I had just locked in this little last bit. That was the big difference. If this was a scratch on Friday and I had traded it the way I meant to trade it, I would not care. But I broke my rules. I didn't trade my game. Made a mistake getting into the trade. So even if I win on it, it's just a bad trade to me. Everybody's different. Everybody has different strengths, weaknesses. There's no one right way to trade. You'll find that people tend to trade in a way that matches their personality. I don't want to interfere with that. So I give people the trades I'm doing, but I don't tell people, you're doing it the wrong way. You have to do it my way. I'm the guru. I know everything. That's the worst thing you can do. You have to find what works for you, and the best way to do that is to use risk management to survive a lot of bad trades until you figure out what works for you. The tools and the concepts, Those work for anybody, but how you approach the trade, that's on you. I think it's a really bad idea to go to these kind of guru websites that, trade like I trade, I made millions of dollars. People just have different risk tolerances. They have different strengths and weaknesses. So embrace those. Those are yours. This is your path, your journey. Don't give it up to some guru who tells you they know everything about the market and you have to trade their way. So I'm sure everybody knows why the market really came down. It wasn't just Powell. It was the Chinese retaliating to Trump's latest round of tariffs. And this was something that was known. It was known it was coming. This is the Twitter feed of the editor for the Global Times, which is basically the Chinese Communist Party's mouthpiece. So look at this tweet. You can pause it. I'm not going to read it. It was 6:30 in the morning. He's basically saying, as far as I know, China is going to retaliate. Guess what? They did that an hour and a half later. The market saw this. Everybody knew about it, but it ignored it. And this is a good Twitter follow, really, for what's going on with the trade war. He's basically the Chinese version of Trump on Twitter. There's something that happens every time before tariffs have been raised or enacted or the trade war has escalated this year, and that is watch what North Korea does. North Korea is dependent on China, so when things are getting tense between China and the USA on trade negotiations, you will see North Korea act out. So you remember in April, markets buying the trade war rumor, the optimism. The White House, Larry Kudlow, we're 90% done to a trade deal. Then North Korea is firing off its first ballistic missile since 2017. 2 days later, trade talks collapsed. You see North Korea fired the ballistic missiles. Here's trade talks collapsing, Trump putting new tariffs on. This happened again over here in July. North Korea fires ballistic missiles for about a week. Tariffs, new tariffs. This week, they removed nuclear fuel rods to replenish their plutonium, which is needed to make nuclear weapons. Tariffs. So here's this consolidation. Kind of looks like a flag too in the S&P 500. So on a 60-minute chart, let's back out a little bit. So the S&P 500 is moving sideways, and people don't know if it's a bottom or if it's a big nasty consolidation. So you have to look at other things. For instance, here's QQQ. Big sell-off, big consolidation. What is that? I mean, that is a bear flag. 3 weeks is pretty typical for a bear flag. And if you look at IWM small caps, which lead the broader market, check out their trend. Sell off, little flag, sell off, 3 week consolidation. That is a downtrend. That's not even a bearish flag. That's a downtrend. Go through S&P sectors. Here's the sell off. This is the financial sector. What is it doing? Downtrend. Technology, the most heavily weighted sector. Bear flag. Semiconductors. Bear flag. Bear flags in the S&P 500. You have bull flags in volatility. A quick look at commodities. So here is USO for crude oil. Same rally as stocks from June into July, but July 15th, about mid-month, breaks this uptrend. It has been trending down in this downtrend ever since. Two of my favorite assets, if you've watched my videos, or certainly if you remember, you know this, gold. So here's gold on a 60-minute chart, or GLD rather. This is the consolidation. The market starts to get risky on Friday. It starts to break out of this consolidation. This has been a spectacularly bullish trend in gold. Here you can see the last year and a half or so, bull flag, bull flag, bull flag, ascending triangle over here, and we have a little triangle this last week. So if we want kind of like a rough estimate measured move, if this continues to break out, which it really is just kind of at the top end of this range, it needs to kind of break above this 144.50 area. But we can get a general measured move. So we just kind of come from this last consolidation and this rally here up to about the top of this consolidation. And then we just add this onto the breakout point right there. And we can pull this down and get a pretty good idea of where that measured move would fall, which is around the 150 area up here. Let me show you a bigger picture of gold also. Look at this breakout from this multi-year consolidation. Okay, that is very, very bullish. This has been one of my favorite assets along with bonds. Here's TLT, another awesome trend all this year from last year. Bull flag, bull flag. We traded these. Missed this one. Another bull flag over this last week or so of consolidation. You can see it there. TLT started to break out on Friday. And on that note, let's look at Treasury's 10-year yield. Here's that epic plunge. It's lost like 120 basis points over the last 6 months. To give you some idea of how behind the curve the Fed is, the Fed has cut by 25. So they are well behind the curve. Here's the last week or so in the 10-year yield. What is it doing? It's got a bear flag here. That's suggesting it's going lower. How much lower can yields go just from this measured move for the 10-year? I get a move that can go down as low as about 1.1%. And that may sound completely unfathomable, wild, but I'm going to ask you to take a look at it from this perspective. That's my measured move target right there. So this tells me, people are worried that the Fed is going to go negative on rates. If we stick to this trend that has been going on for decades, yes, we go negative. So getting down to 1.1% is not a stretch. There's a better look at it from the 80s. So heading into next week, let's take a look at a couple things real quick. These are some trends for the year 2019. So here's the S&P 500. There's the 3-week consolidation. It's below that trend line. We can look at the NASDAQ over here, the NASDAQ 100. It is sitting right on it. There's Friday, kind of dipped a little bit below it. Here's the Dow, below it. And here's small caps, below it. So what we're really looking at here is just this entire 2019 recovery trend and new highs and all that being broken. And again, my opinion is that this is the first leg down consolidation. We have a second leg down that will come down to at least this June low. And when we get there, I believe that's going to break. I think it will consolidate there first a little bit, but I'll show you when we get closer to that why it's going to break. Members, it's about breadth. As far as recession goes, put me in the camp of, yeah, I think we're heading to a recession. Look, this isn't my opinion. I'm not trying to be controversial or scare people, because you can make a lot of money when the market goes down, or in bear markets there are things that go up. Look at TLT and gold. But we have to look at, what are the probabilities, not what we hope for. So the market now hopes that the Fed will be able to cut rates a couple more times, and we'll have a 1995 to 1998 scenario where the market will recover. So let me show you one big difference between now and then. It's the yield curve. This is the 10-year minus the 3-month. It's more accurate than the 10-year minus the 2, but that also inverted, and inverted again this week actually. So we go back to 1995, 1998 when the Fed did their emergency rate cuts and rescued the market. No inversions. Okay, you got an inversion here, recession there, inversion here, recession there. We're inverted again. So now the argument becomes, okay, well, it's different this time. This is the long-term look at the 10-year 3-month spread. And one thing you will probably see before a recession happens is that yield curves will have gone from flattening and inverted to rising, sharply steepening. And what causes this? Fed cutting rates aggressively. These last 2 recessions started about 3 months after the Fed's first rate cut. These curves inverted back in March, but when the 2s and 10s inverted, that got everybody's attention. And maybe even more interestingly, the White House is starting to brace GOP donors for a potential moderate short recession. So heading into next week, again, President Trump raised tariffs again Friday after the close. So the market is probably going to discount that. China is probably going to retaliate to that. Friday closed down near the low of the day, near the low of the week. This is always bearish. You have a big bear flag in a lot of the averages. You have sideways here in the S&P 500. This is pretty typical. First leg down, big consolidation, looking for a second leg down. Maybe we'll get a little kind of whimper rally, which would be what I would like to see at this point. And a whimper rally looks something like this. A very similar consolidation to this was seen in November over here. So there's the first leg down. There's the consolidation in November that's similar to this. And then the second leg down. This was the whimper rally right here. That's the whimper rally. That's what I would really like to see. It looks kind of like a little bear flag. If I had longer duration puts, then I would have left those open. I would have closed half on Friday, taken some gains to pay for the trade, left the rest open. So I'll be looking for some way to get back into the market on the short side into next week. And my expectation is that we're going to get a second leg down that might be somewhere around the June low. So if we kind of take this over here, do a quick measured move, let's say right about there, because that's kind of where we've been seeing support. That would get us actually a little bit below the June low. Small caps, they've already broken below that June low. So that's where I think the S&P and the NASDAQ and the rest of the market are going. But we have to adjust minute by minute to the market. Like I said, I had 13 posts on Friday, and I really laid off on the afternoon to give you guys a break. And that will do it for this video. If you enjoyed the content, you liked the video, please go ahead and give it a thumbs up. If you want to share it with somebody, please feel free to do that as well. I think there will be a subscribe link in the bottom right-hand corner. We'll see if I get that figured out. Also, if you have comments, questions, or you have some content you'd like to see, topic covered, go ahead and leave that in the comments to my subscribers. Just email me as usual. And speaking of which, I will see everybody Monday morning. It looks like it's going to be another really volatile week, so we will start sniffing out some new positions. Have a great weekend, everybody.